G'day folks, I'm going to share with you the tens of thousands of dollars I've been shuffling around over the last week with the stocks I bought, the stocks I sold, and giving you that full clerical insight, that raw transparency into my over $390,000 stock portfolio with the performance, that broader overview, and then we're going to take a look at some of the individual growth positions that I recently just started buying. This is something so many financial YouTubers haven't done since the markets have gone into pure calamity. And before we dive into my portfolio, I want to roll back the clock a little bit to the end of 2021 and just kind of summarize the entirety of this year, because I think the only way to summarize it is nobody knows what the F they're doing. I mean, really, nobody. Don't even trust me. I don't think anybody, including myself, but I'll be the first to damn admit it. You remember going into the beginning of this year when somebody asked Elon when the next recession would be? Predicting macroeconomics is challenging, to say the least, but my gut feel is maybe around spring or summer of 2022, but no later than 2023. And here we sit and we haven't had a real technical recession just yet, right? But even funnier enough, I mean, listen to Tom Lee coming into the beginning of 2022. This is just hilarious.
But I do think for the full year next year, it's a double-digit year, partly because, we're still in a solid expansion. Monetary tightening doesn't kill bull markets, but it creates a lot of volatility in front of it. So I think if the Fed liftoff is in the summer, by December, the markets can look a little bit past that. And so I think we're still up 10% for the year.
Baby, people give this guy millions of dollars to invest, and he literally just said monetary tightening doesn't kill bull markets, even though prior history really shows most monetary tightening periods have led to crazy crashes and not bull markets. The exact opposite, for a matter of fact. And again, this is just one of dozens of examples. I mean, you can pick any YouTuber under the sun. I don't think I have to shout too many out here for you to start realizing, you remember when Carnival Cruise was going to be this incredible power play to the recovery out of the pandemic, and year to date is down 64%, actually back down to its pandemic lows. You remember Tesla stock, all those Tesla bulls. I was a proud Tesla bull for some time. Glad I got out of that position, down 70% leading up to what could be a good buying opportunity for 2023, 2024 perhaps. But nonetheless, guys, man, I don't think too many people saw that one coming. Not even the likes of Kathy Wood here, who is now her portfolio, the ARK Innovation ETF, is 47% below where it was at the peak of 2020, which is staggering. It's now below its pandemic lows. We got Coinbase, the crypto market. Damn, do I even have to talk about Sam Bankman-Fried here? Funny story, making movies out of that crap. AMC, your diamond handers, your GMEers, your apers of the world. When was the last time anybody even mentioned the apes on Wall Street bets? I mean, that shit has fizzled out and has died pretty dramatically. It's just crazy, right? Like the Meet Kevin pricing power ETF. This fool here is already underperforming the markets by double pacing the S&P to the downside. And the only thing that's going to drive us back into a bull market, in my humble opinion, is the stabilization of GDP back to a nominal rate. Gross domestic product, I think, is what's going to completely determine the future of the market. And right now it's just too volatile to see any kind of like real bull market, because you can see coming out of the 2008 financial crisis from 2010 to roughly 2020, we saw really nominal around 2% GDP growth, and that led to a very healthy bull market. And you can see that's been pretty consistent in every bull market. So we need to start seeing a nominalization. And it's kind of funny to see that even in the Canadian economy, guys, there's little signs of slowing amid rate hikes. We're still seeing positive GDP, yet most economists are saying we're going to see a recession and slowing growth between Q1 and Q2 of next year. That seems to be the common consensus across the Western nations, damn it. But let's get into my portfolio itself and see what I've done here. Now, I don't claim to be a genius here, but we're going to look at the exact performance, because I think I've outpaced pretty much any YouTuber you can point your finger at a year to date. But my current portfolio is around 356, because I do have a lot of cash. I sold some positions into cash we'll talk about. I've made a bit more extra money, stacked a lot, sitting on almost $36,000. That's not really including the fact that I bought like an extra $5,000, $10,000 worth of VOO over the last week. I've been buying a lot more VDY, my Canadian high dividend yield ETF, and I consolidated VYM, which is a US dividend ETF, into SCHD, which is another US dividend ETF, but is more focused on the Dow 100 dividend stocks, which incredible performance. We'll look at the performance of this in a bit, but now it's about 20% of my entire portfolio. And when it comes to an individual stock position perspective, you'll notice I've sold off all my dividend stocks. I do have two growth positions for the first time I'm going to talk about in this video, but I did sell all my dividend stocks to focus those primarily on just maximizing these ETFs to take the management out of my hands. I've talked about this going into the end of the year here on my last live stream, that I don't want to focus on dividend income. I mean, to lose an extra $1,000 of dividend income with those few dividend stocks isn't going to make or break my future here when I really just want to maximize performance. And going through these recessionary periods, because I don't know what I don't know, I don't want to have to hand select companies and screw up so many times, like Facebook, like Tesla, like Baba. I mean, the list is endless. Algonquin Power. You just don't know what you don't know. So let the ETFs use a mathematical, non-emotional system to weight the best companies. And then I think once we start seeing bottoms in a recovery, it will be a great time to start cost averaging back into things like Tesla and growth stocks, because I still want to hold individual growth companies. And like I said, I've been buying a couple growth companies, really small cap companies we'll discuss in uno moment here. But yes, so I'm not holding any of those individual dividend stocks right now, which has brought my dividend yield annually down to 10,434, and that's going to bump up dramatically here soon. And the reason I'm going to say that is because I'm going to be buying with my emergency fund about 10 or 15,000 of 4.7% GICs, which will greatly bump this up by another few hundred bucks, because I already have some of that money in a high interest savings account. I'm also going to be taking a lot of this cash, and as soon as I'm able to at the beginning of the year, max out my tax advantaged account, which should and that money is just going to be divvied up between these three ETFs, which should also bump my dividend income by another few hundred bucks. I should nominalize around 11,000 annually. And on that note, we did receive a little bit more dividends for the year of 2022. I will have received about 11,500 to 11,600 in annual total dividends, which is a record for me, which is just absolutely astounding. So needless to say, for the entire year, this has been a very pivotal moment in my entire investing strategy. And we're going to take a look at the performance to see how things have been cushioning into the latter half of this year with since inception performance of my major accounts. But first and foremost, if you do like how I'm tracking my portfolio and you want to support this channel, guys, come on over to the portfoliospreadsheet.com. I'm going to leave the link in the description below. Use coupon code dividends. You'll get 30% off, guys. This is just one of the best ways to track your portfolio with nobody tracking your data, a one-time fee, no monthly fees, and it's just a good place to consolidate all of your accounts so you can get this broad overview and better understand your diversification. And I greatly appreciate the support. But taking a look here, guys, the performance of these accounts since inception, and these are all my major accounts excluding my corporate account. And it's kind of wild to think that coming into the beginning of December, I don't have December data yet, but I do have the data for November. My RRSP actually hit an all-time high, which is kind of wild to consider, because all of these gains here in my RSP, which is represented by this black line, all of that was Tesla, which is just wild to consider that I actually have an account right now that is hitting all-time highs. I guarantee you there ain't no YouTuber out there saying that right now, but do keep in mind, some of my accounts did see some devastation because I was holding Alibaba in this orange lined account. That was my general managed account, and I got devastated on some of those individual positions, but we are starting to see a recovery since I made a shift and started to continue to buy and aggressively buy these indexes when they bottom. As soon as I see a 20% drop in the S&P 500, that's where I'm really getting aggressive. And same with all these other ETFs. When we start seeing the market decline, those are the days that I'm buying heavily. And we can see it's been benefiting the portfolios amazingly because they're bouncing a lot heavier than the basic indice, which is represented by this dotted teal line. That's the S&P 500. So we can see that I'm still able to outperform the S&P by just buying it at certain periods when the market is downturning rather than buying the rallies back. Now, since the inception of 2014 when I started investing, guys, my managed account is up 306%, TFSA is up 153%, RRSP is up 282% against the same time period of the S&P 500 that's only up 103%. Kathy Wood looks like a joke to the performance of these damn accounts. It's kind of wild to consider. Now, let's take a look at the individual positions. We'll start with the ETFs, and then we're going to talk about these two growth stocks that I've been buying. But first and foremost, the Schwab US Dividend Equity ETF, the one that I've doubled down on, and I think is going to be a fabulous additive and an easy one to cost average into with a drip, because year to date, this one's definitely outperforming the S&P 500. 5-year performance is, it's just a stellar ETF in my humble opinion. Many of you know this. It's very famous amongst the investing community. Against VOO, I'm using these dividend ETFs to stabilize this, because right now this is where I think most of my primary growth will be coming from in the future. I'm still very bullish, but I wouldn't be surprised if we see this bottom out somewhere around 300 and 320 330s ish. 300 to 330 I think is where we're going to start seeing a bottoming, but that's just a stupid random guess, and you can tell I'm not investing based off that stupid random guess. Like I said, I just buy these dips here. Like I bought aggressively $10,000 worth in this October low. I've been buying aggressively right here because again, this is where we're back down to 20% under. I don't know if we test these lows again. I'd like to think we do, but who the hell knows, right? So continuing on, VDY, my Canadian high dividend yield ETF. This sucker makes me almost $500 a month. This is my gem to the Canadian markets. This is going to be probably the only real Canadian stock I think I need to own at this point. And I'm just going to continue to reinvest the dividends. The performance doesn't come damn near close to the performance of SCHD or VOO, but again, I am just holding this for dividend income because it yields well over 4%. It has good dividend growth and great exposure to the Canadian economy. So from those, the only growth companies, and I did buy one in the last week, is a company called Aduro Clean Technologies. This was a proud sponsor of my channel and a stock that I have come to fall in love with. This is just one of the odd occurrence penny stocks that have outperformed the S&P 500 this year. But again, I'm not buying it because it's outperforming. I'm buying it because this company has been backed by Shell, claiming they can turn plastic wastes into fuels. And it's kind of wild to consider this is the first real pure play into a company that's going to be ramping up over 2023 with full ramping into 2024 and 2025, that they can make millions, tens of millions of dollars off taking waste plastic from the ocean and everywhere else and recycling it into fuels that has even caught the attention of Shell. So I am buying this stock. I bought about $250, $300 worth. I'm only buying it with what I'm going to call my speculative money. Every month I'm going to buy maybe $250 to $300 worth until I get about $1,000 worth of it, and then I'm just going to coast with it over the next couple of years. It's the same thing that I've done with an angel investment I don't talk about called Green Butts. I can't really show it because it's not publicly traded. I put $1,000 in it at a funding round of about 15 cents a share, and they're basically making biodegradable cigarette butts, and they've already partnered with tobacco giants, and now they're already doing a funding round for 30 cents, which is double what I paid for it, and they're supposed to be coming public. They're looking to do a public funding round, and I'm not sure when exactly that'll happen, but of course I'll tell you about it. So I'm really excited for this company. I've talked to a lot of insiders, and it's just one of these small caps that doesn't feel scammy to me. It just feels like they're more concerned about solving this problem and making sure the technology works. And just the fact, again, they have Shell on board, the oil giant, I just think it's going to say a lot for the future potential of this company. But finishing up here, folks, I mean, it's been an odd day. It looks like we're going to see a little bit of green coming into the long weekend. I do like the red days here because, like I said, this is where I think we're truly going to get rich. And I'm going to reiterate this again, that I hope so many of you followed the advice, not my financial investing advice. You buy whatever the hell you want. But what I do offer that I think is solid advice is no debt, no auto loans, no student loans, no credit card debt. Sell your shoes, sell your bed, live frugally as hell, and invest for the next 10 to 15 years, especially in moments like this. And we're all going to be retiring very early, very rich, and very wealthy. And I hope you continue to follow me and you're going to be part of that journey, because I want to see you do just as well as I'm doing. As again, unlike all these other YouTubers, guys, I'm going to be always fully transparent with you. So stay cool, stay awesome. And as always, I look forward to catching you in the next one.